Good afternoon, my name's Darren and today I'm going to be talking about RIOs. What's a RIO, you might well be asking. What we're going to be looking at is the route to RIO. So there we are, looking a bit confusing. What's a RIO, where do we go, how do we discuss it? So that's what I'm here for. What is a RIO? I'm going to talk to you about what it is, who's it for, what the benefits of a RIO are, what's the catch of a RIO, and what other options there are for you. So a RIO, first of all, is a retirement interest-only mortgage, which, as the name suggests, is mainly aimed at older people, mostly for over 55s. There are one or two providers who go down to the age of 50, but they are rare, and generally speaking, the products are more suitable for people over 55. They are a low-cost option for mortgages for those people, and the one advantage is they being interest only. The main issue most people have interest only is having to repay the capital at some point. That does cause a problem. There are a lot of people at the moment currently coming to the end of interest only mortgages that they already have and are finding that they can't pay them off because they don't have that capital, and they're looking for alternatives. This is one of the reasons that RIOs were introduced, because they therefore bridge that gap and allow you to remortgage to an interest-only mortgage again. So it's still the same low cost you're currently used to, but this time there's no end dates. That's the main benefit. It means that you don't have to repay at any time until you want to. Okay, so let's look at the difference between mortgages. And I'm going to compare these to normal interest-only mortgages and also lifetime mortgages. Now, lifetime mortgages are more commonly referred to as equity release, but for this purpose, it's not an equity release, it's just a mortgage. So let's look at the difference. So first of all, look at a normal interest-only mortgage. They tend to have a fixed term. As I say, many people have come to the end of their fixed terms now and finding they've got to repay the capital. Minimum age tends to be 18 to 20, whatever the minimum age for normal mortgage lenders are. Maximum age will normally be limited in most cases to 65, 70, maybe 75. There are one or two lenders that go up to 80 or 85, but they do have quite tight criteria. Minimum equity required in the property. Normally, this is part of the requirement. You must have, on top of the mortgage, so an equity of typically about 150,000, depending on where you live. Many areas as much as 200,000, and that would mean that your house, if you had a mortgage of £150,000, your mortgage would still have to leave you with £150,000, so your house would have to be worth at least 300. And obviously that does get tighter in some areas. Maximum loan to value for interest only. Most lenders cap the maximum you can borrow to 70%. So in that respect, on a £300,000 house, the maximum you can borrow is 210, but then you couldn't do that because there wouldn't be £150,000 left anyway. So in many ways, the maximum loan to value doesn't work for most people. Monthly payments, yes, you must make monthly payments. That's compulsory. There's no interest roll-up option, so you must carry on paying until the end of the term, and at the end of the term, you pay back the whole mortgage. Repayment vehicle required, yes. What we mean by that is how you're going to pay the capital off. So in order to take out an interest-only mortgage, you must already have in place a means of paying the mortgage off. So in this case, that's why they're asking for typically £150,000 equity. What they're saying is, at today's prices, if you were to sell the house tomorrow and pay off the mortgage, there'd be £150,000 left. That's enough to buy you something to live in. May not be the sort of house you'd like to live in, but it will be something you can buy. Nearly most places in the country you can find a house for 150. If you live in London, the equity tends to be much higher, and that's reflected in the criteria of the lenders. Affordability assessment, yes, you are tested on whether your outgoings and income are sufficient to carry on paying the mortgage, just as you are with any other mortgage. And the property at risk, yes. If you don't pay your mortgage, they can repossess you and you could lose your home. Another reason why they insist on the equity, because if they did that to you, they don't want to make you homeless. Okay, so that's a standard mortgage. Now the RIO, slightly different. First of all, there's no fixed term. It runs until the day you die, or you both die if it's a couple. So you don't have to worry about having to pay it back at some point. Typically start at 55. There are one or two providers doing age 50 products, and there are a couple of products that kind of fit between this and a standard interest only mortgage, not quite a RIO, but very similar. Maximum age, because they run until the day you die, then obviously there's no maximum age. You can take these out whenever you want. Minimum equity, not applicable, because you're not going to be made homeless ever. You can just carry on paying. Maximum loan to value, most cases is 50 to 55% of the property, so there will be equity anyway. Monthly payments, yes, you must make, with a RIO, you are committed to making the interest payments every month. Interest roll-up option, no, because you have to keep paying. Repayment vehicle required, no, there isn't, because the repayment vehicle is you selling your house when you die, or when you move out to go into care, or whatever it might be. Affordability assessment, yes. In this case, it's based on the interest-only payment, which probably makes it more likely you'll pass. But I'll come to that in a minute. That is one of the catches as well. And your property is at risk. With this particular option, if you don't pay those payments, you could lose your house. It could be repossessed. So that's a very important factor to RIOs. Although they don't have an end date, they could still repossess your house. You could still end up homeless. Very important to understand that. Again, one or two providers have products that have the facility to switch off the interest and not make you homeless, but that's uncommon. And obviously that's why the advice of a good equity release and later life lending specialist like myself is important. Okay. Final option, which is one of the other options you could have, is a lifetime mortgage. So we looked at normal interest only mortgage as an option, RIO as an option, and lifetime mortgage as an option. Now, as I say, equity release is the name that most people give it, but it's not equity release, it's just a mortgage. So it's exactly the same as a RIO, exactly the same as a normal interest only mortgage. Here's the differences. Fixed term, no. Just like the RIO, it runs until the day you die. Minimum age, as I said there, typically 60. You can actually get equity release from 55. Most lenders have restricted it more to 60, and reality is that most advisors would think 65 plus, except for specific circumstances. So expect to be steered towards a RIO if you're under 60 anyway. Maximum age, no, there is no maximum age, again, because it runs until the day you die or go into care, and there are rules around that, which I'll talk about in a different discussion. Minimum equity, no, because it's just about building up the property. When I say no, there is a catch to that, because the loan to value takes into account equity. Now, maximum loan to value with equity release is age related. So the younger you are, the less you can borrow, generally speaking. So if you think about age 65, say, you might be able to borrow 25 to 30% of the property value. At 80, you could borrow 55%, perhaps. So, and that's on the basis that, because there's an interest roll-up basis on these, that the more years you've got for the interest to accrue, the less equity you will have. So they need to make sure they've allowed for that in the first place. All right. So monthly payments, no. Although you can voluntarily make payments, and this is the big difference. RIOs and interest-only mortgages, you have to pay the payments. But if you don't want the interest to build up on an equity release mortgage or a lifetime mortgage, you can pay the monthly payments. So it gives you the same deal as the RIO without the potential that you can't afford it. Interest roll-up option, as I say, is normally the standard where we start from, which means you make no payments if you don't want to. The interest is added to the mortgage. I've covered that in other discussions. I will come back to that another day, but for this purpose, that's the difference. Repayment vehicle required, again, no. It's just a sale of the property upon death or going into care. Affordability assessment, and this is where lifetime mortgage differs from the other two options. There is no affordability assessment. It's based purely, when you raise a mortgage, a lifetime mortgage, based purely on your age and the value of the property. If the property is acceptable, they will a loan to value they'll give you is based purely on the value of the property and your age. So You don't have to be able to afford the payments. Even if you want to make them, you don't have to be able to afford them. Very important that, and I'll be coming to that in a minute. Property at risk. Again, another plus of a lifetime mortgage. You will never, ever be asked to leave the property. You will never be repossessed, because if you're not committed to making payments, they can't turn around and ask you to make payments or on your bike. So that's the big difference. That's the only option that guarantees you stay in your home for as long as you want, unless you don't comply with the rules of the mortgage, which is that you maintain the property, which I would hope you would do if you're living in it. Okay, so they're the differences. So what's the catch? Well, there's something called the stress test. This is specifically relating to RIOs. It's an affordability test. You say that's not a catch because you have an affordability test and a standard mortgage as well. This is quite significantly different though. In a normal mortgage, you apply when you're 25 for a mortgage. A couple, both earning £30,000 a year, they work out how much you're going to afford to pay, give you a 25, 30, 35-year mortgage, say yes, tick the box, away you go. That doesn't work on a RIO. What they actually do is look at your current incomes or your pension incomes only. It's based on pension income only because you're going to be retired at some point if it goes on for the rest of your life. So it's based on your pension income, state pension, personal pension, employer's pension, all those things. And then they calculate whether you can afford it. But then they do the stress test. And that's where most RIO applications have failed. And I say most, I don't mean that's the reason that the failures mainly fail. I mean most applications fail. A very small percentage of RIOs actually get accepted. And this is because of the stress test. And what they actually do is it's based on the survivor of the two of you. So if you're a couple and you have two state pensions, one of you's got a bit of an employer's pension, one's got a personal pension, and perhaps a top-up pension of their own. They then look at what happens when one of you dies in a few years' time, because it's going to happen if it runs for the rest of your life. At some point, there will only be one of you. And they look at that and say, right, okay, so when Mr. Smith dies, his state pension stops. So that's the income gone. His employer pension, which is currently £10,000 a year, becomes £6,000 a year to his spouse, Mrs. Smith. So she's now got her state pension, plus a £3,000 a year personal pension she had, and now she's got £5,000 from his employer's pension as a spouse's pension. She's now on about £18,000 a year. They redo the calculation and say she can't afford the mortgage, so it gets declined. And that's very difficult to get past. So realistically speaking, most people who pass the test for RIOs have significantly higher pensions personally themselves than most people do. That you would require a decent employer's pension for both parties on top of the state pension. So that's quite important, because the minimum that income that's going to be required to cover costs as far as a lender's concerned is around £16,000 a year. So state pension being between £8,000 and £10,000 for most people. Personal pension of £5,000 to £6,000 on top of that. That's just your cost cover. That's not paying a mortgage and that's not living. So it's unlikely that most people will actually get a RIO. So you have to look at the options. So, but if you do get a RIO, you have to pay the monthly payments. I say at some point in the future, it might become appropriate to switch to a lifetime mortgage. At any event, your RIO mortgage is going to be a fixed monthly cost. It will be a fixed rate mortgage, just like a standard interest only mortgage. I'll go back to that. You get a fixed rate mortgage, interest only mortgage, retirement interest only mortgage are both fixed rate, typically for 2 years, 5 years, and in some cases 10 years. And there is in fact one product at the moment that's available that is a lifetime fix. But the longer you fix a rate for, the higher the rate starts at. Typically, a 2-year fix on a RIO is going to be around 3%, give or take, 3.25, something like that. A 5-year fix might be 3.5 to 3.75, that sort of thing. A 10-year fix is going to be over 4%, maybe 4.25, and a lifetime fix is probably going to be more like 4.5%. But if you take a 2-year fix, obviously you're going to have to revisit in 2 years' time. You may not meet the criteria, then you've got a problem. You may not be able to remortgage to a better deal, or interest rates could go up at that point. And then what are you going to do? It's going to get more expensive. The lifetime mortgage also is a fixed rate, but that's a fixed rate for life, guaranteed from day one. And that is typically at the moment running between 2.6, 2.7%, 2.79 is a good average rate, up to about 5%, depending on the deal. So you could certainly get many deals around 3 to 3.5%, the same as the RIO rates and the same as the traditional interest-only rates, but that would be fixed forever, and you'd never have to make payments if you don't want to. So that's something to think about. The stress test is another issue with RIOs. The interest rates are another issue. So on that basis, I think you have to really talk to someone like myself, a specialist in the later life lending area, to make sure you get the best deal you can that's most suitable for you, that can be changed if necessary with that advisor's help going forward. So that's me for today. Thank you for listening, and that's me. Cheers.